Hello there, and welcome to Homeownership 101 after COVID-19. Today, we will discuss how to buy a home in 2020, especially after this pandemic that we're going through. So, I'll give you guys a few minutes. I suggest you grab something to write with, pen and paper. If you're on your cell phone, then screenshot will be an option so that you can save some slides or information that you may need in the future. So, I'll give you a few minutes before we start. I hope we're all ready, and let's begin. What we will talk about are the benefits of homeownership. So I get this question a lot. Should I rent? Should I buy? Is the timing right? Should I wait? And the answer for me is the timing is always right. More often than not, the prices of homes will go up unless we are in a situation like this where that might be different. And we'll discuss more of how the virus is affecting traditional housing market later on. But having stable housing costs, being a homeowner, you will have a mortgage as opposed to rent. And all of us who rent know that your rent can change every year when you renew your lease. You don't have that issue when you are a homeowner. Your mortgage will stay the same. You do have the option to refinance, to pull some equity out when you have that. There is the tax benefit that you will receive when filing taxes and claiming the interest that you're paying. And you're also controlling your own environment. You have the option to tear down a wall if you want to paint a room, to add a room, to build a pool in your backyard, whatever you'd like. And you have that stability. So I always suggest, if at all financial possible, to buy a home. Now, there are some barriers that make it hard for us to be successful as homeowners. And that's when you buy a home that you cannot afford. Dealing with a real estate agent that you trust should help to overcome a lot of these barriers. But I want you to keep in mind what's important. When you have a mortgage, there's your mortgage payment, and there's also other things that come along with home ownership. And we'll talk about that later, but I want you to note that. So make sure that you can afford the home. You don't want to be house poor. You don't want to be in a house that you bought and all you can afford to do is your mortgage. You can't afford to furnish it. You can't afford to live life. You can't afford to enjoy it. That's not the goal. So make sure that the home that you buy is affordable. Part of that is choosing a loan with a payment that is not going to increase. And there are loans out there that are like that. So you want to make sure that you are aware of what you're signing. Also, spending your equity. As you start to pay down the loan, the home was 400,000. Over the year, you get down to 300,000. That difference is equity. And that amount, you could refinance and pull that money out. That is something you want to be careful with. Only do that when necessary. Okay, and we'll talk more about that later. Also, you want to be aware of the property taxes and the homeowner's insurance premiums. Make sure you stay up to date with those because those are debts that can affect the home. They can put a lien and also lien over to foreclosure if those particular bills are not paid. You want to make sure to maintain your home. It's an investment. It's going to be worth more in the future. So you want to keep it up to par. You want to keep it clean as much as possible. You want to make sure the yard looks decent. You want to repair things when they're fixed, or I should say, you want to have the money to be able to repair things when they need to be fixed. Also, make sure that being a homeowner, you do have other benefits. There are ways and workout programs that your mortgage company can help you. So as soon as you feel like you can't make your payment or the day that you know that you can't, call your mortgage company. Don't be scared. Discuss that with them. They don't want your house. They want your money. They want you to keep paying. So there are options and programs that can help you if you do fall behind. So now that we talked about some of the benefits of buying a home, we're going to go through the entire homeowner process. We'll start with what I call like the 5 easy steps to homeownership, what you should do to prepare. We'll go over the different buying programs and mortgage loans that are out there, how your real estate agent can help you, how your lender can help you, and the actual process of buying the home from start to finish. So I like to start with mindset. A new mindset breeds new results. And a lot of times we can get on our own way. So it's important that we are aware that we can do it. It is possible. You have to believe that you can do it before you start this process. This is going to be the largest purchase that you will make in your life, most likely. There's not much things that are more expensive than a home. So you have to believe that you can do it. And things that can help you to do that is to educate yourself. If you know what you're getting into, you know how to prepare. And there are people and resources and options out there to help you to educate and prepare for the biggest purchase of your life. Now, the next thing we need to worry about is budget, your money. And I get this a lot, I can't afford it. I always say if you're paying rent in California, you can afford to buy a house. There are ways to get around it and there are ways to make it possible. If there is a will, there is a way. And the first step to that is creating a budget so you can understand exactly what you're working with when it comes to finance. How much money is coming in, how much is going out, and if changes can or should be made. So, when I teach budgeting or I help a client with budget, the very first step would be to grab all of your recent pay stubs, all of your income, regardless of what that is. If you are receiving child support, that's income. If you receive food stamps, that's income. If you are receiving any type of public benefits, that's income. If you work a job, if you are 1099 or self employed, all of that is income, and you want to build this or get all of those documents for a 30-day period. Also, in this day and age, a lot of us swipe our card and we use our card more than cash. So, along with receiving your income, you want to track your expenses. And one of the easiest way to do that is looking at your bank statement. So, how we would start is you write down all of your income, list them, total them up for an entire month. Then you write down all of your expenses that you can find on your bank statements. Everything that you spend, itemize it, put it into a category. And I have worksheets and apps that can help you with this if you need help in this category. You also want to look for your credit card debt. You want to include things that you are paying and even things that you are unable to pay for, because the goal is to be able to make your money work for you and be able to pay all these things. Don't forget your car payment, maintenance on your car, gas, utility bills, cable if you're paying for cable, internet, food costs, insurance, medical bills, even those things we don't pay month to month, like your registration on your vehicle. You want to include that. And how you add something like that is you take your car registration, you divide it by 12, and you put that monthly amount into your budget. So that way you're saving every month for your registration. And so when it's time to pay, you already have it. You're not running around trying to figure out where to come up with it. So once you have all of your income, all of your expenses, the next month, now mind you, this is probably about a 90-day process. So I'll start again. Month 1, we get our income, our expenses, and all of our debt. Month 2, we're going to track that. We're going to make sure we didn't forget anything. Sometimes we have bills that come up that maybe we paid cash and now this month we use our card. You want to make sure that everything is accurate. And you also want to start to build goals and make adjustments. If there's any way where we can cut costs and save money here to put money aside, then we want to start to do that and build a plan with that. When we are evaluating our budget in that month 2, we want to make sure. Now, grab your pens and paper. If you don't remember anything else that I say this evening, make sure that you remember this. You want to pay yourself first. This is one thing that we seem to forget. We'll pay our rent, our car payment, we'll go to Starbucks, we'll get our nails done, our hair done, whatever the case may be. But saving is a lot of times the last thing on our checklist. And we need to reroute that, change that mindset, and save first. The goal is to save 10% of your income. Put that aside before you pay anyone else. And I want you to change your mindset and start thinking about money in a different way. Instead of paying bills and responsibility, think about how hard it is for you to come up with this money and how you are contributing to someone else's wealth. When you pay rent, you are contributing to your landlord's wealth. When you pay the cable company, you're helping them get rich. When you go to Starbucks, you're adding $5, $7 to their income. So before we start making anyone else rich, we need to start paying ourselves first. And the goal here is to build an emergency savings first of $1,000. Okay? So we're going to start putting 10% away every paycheck, pay all of our bills, make changes where we can. And once we reach $1,000, then our next goal is to plan ahead for 3 to 6 months worth of savings. Okay? When we're doing our budget, you want to make sure that everyone is involved in the household. If you have kids, get them involved. Have them sit down. Let them understand how much electricity bill is, or how much rent is, or how much cable is. Start talking to your kids about money as soon as possible so that they can understand and learn how to save and how to make their money work for them as opposed to working for your money. Okay, and we always at this process, we want to look for ways to increase income and reduce expenses. And once we have that figured, we move to the third month and we can start to move things around. If you have an extra goal of buying a home and you need money down, you'll build that into your budget. If you need to pay down some credit card debt, you build that into your budget. Now, again, we offer help and assistance that can help you along this way. So if that was a lot, don't worry about it. We can help you. The very next step is credit. Okay. Now, credit can be either something you love or you hate. It just kind of depends on where you are. And I want to be frank with you. For years, I had horrible credit. I don't know. My score was, I don't even know if it was a 400. I was a victim of identity theft, and people were using my credit to run up things. And then also, I was struggling financially. And when times got hard, there might be a bill that I couldn't afford to pay, and it was on my credit. I didn't have a good credit score, so I really wasn't thinking about monitoring that until I started teaching these classes and educating people and understanding how it works. And what we need to understand about credit, the first thing is there are three different credit bureaus. There's Equifax, TransUnion, and Experian. All three can and most likely will look slightly different. There are some companies that report to only one. The majority of large companies are going to report to all three, but you'll be surprised where you might see, if you get furniture from a store finance, they might only report to Experian, and that bill or that debt won't be on the other two. So you want to make sure that you're aware of all three because when purchasing a home, the lender will pull all three credit reports. They'll get scores from all three. They'll throw out the high and the low, and they'll use the one in the middle. Okay, so it's important that you evaluate all of them. Now, this is something you want to write down. This is the only website in existence where you can get a 100% free credit report. Now, there are other websites that might give you one for free with a 7-day free trial or give you examples if you sign up for this and sign up for that. This is absolutely free. Annualcreditreport.com. Go to this website and you can pull all three of your reports. If you're familiar with your credit report and you've looked at them in the past and you know what they are, I would suggest pulling one every 3 to 4 months. So that way you're looking at your credit all throughout the year. But in the beginning, for your first time to get you started, pull all three. What you're looking for are make sure that your addresses are correct, your phone numbers. You're looking for any creditors that you owe, that you don't owe. You're looking for things that can be disputed or identity theft. You're looking for payment amounts. Okay? All of these are important when evaluating your score. Okay? Now, I mentioned before that I had horrible credit in the past. And what I did not know is what actually made up credit score. And being that I had collection accounts, I was always under the assumption, oh, if I pay these off, then my score will go back up. Well, that's not how it works. If you see here, this pie chart shows you the 5 different parts of your credit score. Payment history is 35% of your score. So that's when you make your payment on time, you will build 35% of your score or lose 35% of your score if you're late. Outstanding debt is another 30%. Now, this is a little bit tricky. What outstanding debt is, it's really utilization. How much of your credit you are actually using. And the only way that you will have this 30% incorporated into your score is if you have credit cards. This is only based on how much of your credit card balances you are using. So if you have $1,000 credit limit and you spend $500 of that limit, you're down to 50% utilization. Okay? Anything over 50%, you start to build negative points into your score. So you don't have to be late. You can make your payments on time every single month, but just because your balance is over 50%, you will almost be kind of at that point to where your score doesn't move. And a lot of times people are like that. Like, my score has been 600 forever. Why? I make my payments on time. Well, because all of your cards are over 50%. As soon as you start to pay that down, the closer you get to zero on debt utilization, the more value this particular circle of credit reaps into your score. When you're buying a home, lenders like to see no more than 20% credit utilization. Okay? The next is length of credit. 15% of your score is how long you've had credit. So another thing that people will do is pay off their credit cards and close them. And then call me like, why did my score drop? Well, you got that card back in 97 when you went to college and you paid it off and closed it. That was the oldest credit card you had. So now instead of having 20 some odd years of credit, you only have 2. That's going to hurt your score. So that's another thing you want to look at when you're looking at your credit report. Sometimes closing cards can be beneficial if we don't have self-control, but we want to make sure we close the right ones. Make sure we keep the oldest one open and active. A lot of times, credit card companies will close your account if you're not using it. So once a year, you can charge $10 and pay it off, just to keep it active. The next part of your credit score is pursuit of new credit, inquiries. When you apply for credit, regardless if you're approved or not, just because you're looking for credit, and most of the time that means we're looking for an avenue to spend money we don't have, it's going to drop your score by 10%. Okay, so just keep that in mind. And then types of credit. The more variety you have, the better. And there are different types of credit. There are credit cards, which are revolving. There are installment loans. And the difference between a credit card and an installment loan is this. A credit card, which is revolving, that means you have a limit of $1,000. You spend it, you pay it down, you spend it, you pay it down, it revolves. An installment loan, an example of an installment loan would be a car loan. You buy a $12,000 car, you have a $15,000 loan, you make your payment in installments until it's paid off. It doesn't go back up. It's constantly going down. Then there's a mortgage. So the more options you have, the better. It's not a lot, but it is 10%. So keep that in mind. Now, I told you before about me having old credit card debts and collection accounts. Have you noticed that none of that is in your score? There's not a piece of this pie that says collection accounts. What happens is when an account falls past due, you'll get hit in the payment history section. You're 30 days late, let's say it'll knock off 30 points. You're 60 days late, that's another 30 points. 90 days late, another 30 points. 120 days late, another 30 points. It goes to collections, another 30 points. When you pay that off and remove it from your credit report, you don't get those points back that you lost. You just get the debt removed from your credit. So the only way to have a good credit score is to use your credit so that you can reap the benefit of having a good payment history. You'd have to have a credit card. And credit cards, ladies and gentlemen, credit cards are a means to build our score. They are not our emergency savings. They are not a way to get to the next paycheck. They are nothing more but a benefit to improve our score. So we need to make sure we get them and use them for that purpose only if we're trying to rebuild our score. Okay? All right. So the next step, after we get over our mindset, we get that together, we get our budget together, we work on our credit, then you need to find you a real estate agent you want to work with. And so in this day and age, we have a lot of information available to us online. There are websites where you can look and shop for homes, but there is still a need for a real estate agent. And what a real estate agent does for you, or should do, I should say, um, is help you along the process. They should be the one to help and guide you, refer you to lenders if you're not working with a lender or an inspector or a handyman, help you with your budget if you're not sure how much of a home you should purchase or what payment amount is right, educate you, guide you throughout the entire process. Be the local expert. Let you know if this neighborhood is good and if this price is right for this neighborhood or this house. Show you homes, let you inside. Most of the time, you can't get in without a real estate agent. They'll also help to submit the best offer. Okay, a home might be for sale for 400,000. A real estate agent is a trained professional to let you know if that price is good or bad, we should offer more or less, and help to negotiate the very best deal for you. The next step will be a lender. If you're not working with a lender, your real estate agent should have a relationship with a lender that they can refer you to. And what the lender's job is to help you to get financing. And people ask all the time, is it possible to buy a home with no money down? And as you can see, yes, it is. These are all the different types of programs, screenshot this if you can, that are available to us to help with down payment assistance or closing cost assistance. Okay? When you get a loan for a home, there has to be a down payment and there will also be closing costs, all of which will come out of your pocket. The loan pays for everything in the middle. So if you can find a program that will cover your down payment and maybe the same or separate program that will cover your closing costs, that's how you can buy a home for nothing down. There are little fees that you can get around, but I wouldn't suggest, like inspectors and things of that nature, but that's how you can do it. Okay, so there are programs, there are options depending on your who you are, how much you make, where you're buying. There are different options. It can be a silent second mortgage, which means you have your first mortgage and you have a second mortgage that covers your down payment, but it's silent. You don't have to make a payment on that second mortgage until you sell the home. Or sometimes, if you stay in the home for 5 or 10 years, that silent second goes away. And then the other option is a grant, where they just give you the money flat out. Not you in your hand, but it goes into escrow to cover either the down payment or closing costs. So those are all options. Make sure your real estate agent and your lender help you to find what's appropriate in that area. That is their job. Okay, so ask if you need it. Now, when you call a lender, what happens? Well, the first step will be a pre-qualification. You'll give the lender a call. They'll ask you, basic questions about your income, pull your credit, and they'll give you a pre-qualification. That is completely different than a pre-approval. Okay, so just remember, a pre-qual is based off of basically your word and your credit report. But a pre-approval is when you have to bring in your pay stubs, bank statement, tax returns. They'll run your credit and confirm that everything that you're saying is actually accurate. Okay, so there's two different steps, the pre-qual and the pre-approval. All right, now, once you get the loan, the lender is going to tell you basically you're approved for $200,000, and that will make your mortgage payment $1,200. Now, what they're referring to is the principal and the interest will equal $1,200. More likely than not, they are going to suggest to you an impounded loan. What an impounded loan means is that your property tax and your insurance is impounded into your mortgage payment. So that way you don't have a separate bill. That is optional, but it is highly suggested because if you don't pay your taxes or your insurance, you can lose your home, even if you're current on your principal and interest mortgage payment. Okay, so what an impounded loan is, it's a mortgage payment that is going to include your property tax and your insurance. And how they do that, because property taxes are only paid quarterly, so 4 times a year, and your insurance is a monthly payment. Your lender will open up an escrow account similar to a savings, and every month when you pay, so instead of $1,200, it might be $1,500 you pay. They'll take that extra money. One part of it goes to taxes, one part of it is insurance. It sits there, it builds interest, and once your taxes and insurance is paid, it goes out automatically, out of sight, out of mind. You don't have to worry about it. Okay, so that is an impounded account. Now, beware of predatory lending. Okay, your lender should provide you with several different options of loans. It might be zero down, $1,500 payment. It might be $5,000 down, $1,300 payment. There's going to be options, different interest rate, different terms, and you want to make sure they're not pressuring you to one or the other because it's 100% your choice. If a lender comes to you and tells you you're approved for this loan amount and this payment only, you want to ask questions because you should have options to choose from. And they can't determine what is best for you. They can offer you guidance and suggestions, but it's ultimately your choice. So make sure you're aware of different sales tactics like that and ask questions. Okay? Be aware of high interest rate loans and fees. If they tell you your payment is this and your payment is that, ask what the interest rate is. You'll know if it's high if all the other rates they give you are lower. Okay, you also want to be aware of a balloon payment. What a balloon payment is you make your $1,500 payments every month, but after year 20, you owe $15,000. That's a balloon payment. You want to stay clear of that. And also, you want to stay clear of prepayment penalties. What a prepayment penalty is a penalty for paying off your loan early. If you hit the lottery and you want to pay your mortgage off, you want to be able to do so without it costing you extra money. Okay, so be aware of all of these tactics. Screenshot this, write it down. This is what's important. All of these are deceptive and fraud. Okay, now that basically covers the 5 easy steps to home ownership. Now, I'm writing a guidebook that will walk you through each and every one of these steps in detail. There will be handouts and other webinars and one-on-one mentorships to get you ready, help you through your budget, write your budget, help you track your expenses, help you to save costs, move money around, save money, get your credit together, help you read your credit report, how to improve your score, get you to where you need to be. Help you find a real estate agent, help you with that lender. If you're not unsure where to go or if he's telling you the right thing, the whole program will include one-on-one mentorship. And I'm doing this free of cost. I have 10 slots left available. So if you're interested in buying a home, Please make sure you stay to the end, and I'll give you all the contact information where you can reach out to me. You'll be one of the ones to get your free guidebook early, and you'll also get one-on-one mentorship with me. I'll guide you through the first 5 steps. It doesn't matter if you're 3 months away or 3 years away. We are going to work this out together. Okay? Once you get those 5 steps in order, then the fun starts. Okay? That's when you start shopping for your home, you figure out which one you want, and you submit the offer. Your real estate agent will write in the offer how much your down payment is, how much your loan that you chose was, plus the interest rate, any contingencies. And what a contingency is basically saying, we will move forward with this loan if XYZ happens or doesn't happen. So, for example, one contingency is appraisal. If you're buying a $300,000 home and they get an appraisal for $200,000 home, you can walk away from the deal because it's not worth the amount they were trying to sell it to you or what you're agreeing to pay for. Another contingency is if you're selling your own home. You can say, I want to buy your home, but I cannot buy it until I sell mine. That's a contingency. You also can say, I want to buy your house, but I want you to put new carpet in. I want to buy this house, but I want all the appliances. I want to buy this house, but I want you to paint. All of these are options you can include in the offer. And then the other part is the length of escrow. How much time are we giving the escrow company to process all of this? Typically it's 30 days. Sometimes it might be 45 or 60 if you are moving from, a different state or another location and you need that extra time. So what exactly is escrow? Well, escrow is the use of a third party. So it's not your real estate agent or the other person's real estate agent. It's a completely separate entity that holds all of the money, and they make sure that everything that we are writing in the deal actually happens. And this takes time. It typically takes about 30 days when we're dealing with a loan. If this were cash, it would be a lot sooner. You can do it in 10, 15 days. So basically, we submit the offer, your real estate agent gives it to an escrow company, and they open escrow. Okay? Once escrow is open, you submit your down payment. The title company will run the title to make sure that the previous owner or the seller doesn't owe any debts that you would then be liable for if you were the new owner. They'll make sure those are taken care of. If there are debts, they'll get paid out of the seller's proceeds. This is when you'll do your appraisal to make sure that the home is worth exactly what you're paying for or more. You'll do your inspections, and this is when we start to remove the contingencies. And then escrow also handles the closing. So we'll go over a few of these in detail. The home inspection is important. This is one of those fees that I told you that you could get away with not paying if you didn't want to. But I highly suggest you have a home inspector. You must have the home inspected, but it can be by anyone. If your dad is handy, he can inspect your home if you want. I wouldn't suggest it, but that is an option because you don't have to pay him. He can walk through and say, yep, the house is fine, buy it. What a licensed inspector will do is they will turn the water on. They will flush the toilets. They'll turn the air on. They'll turn the heat on. They'll get on the roof. They'll check the roof. They'll check cracks in the wall. They'll check all the windows. They'll check every single thing and give you a report and let you know what needs to be repaired, what possibly could be repaired, and what may need to be repaired sometime in the future. So again, I always suggest that you find a certified inspector. All inspectors who have inspection companies don't have to be certified, but that certification just gives you an extra buffer of assurance that what they're telling you is accurate. So you want to interview at least 3. If you don't know where to start, your real estate agent should be able to offer you some suggestions, but it is your choice who you decide to go with. Do not let your agent tell you, oh, use this inspector. It's completely up to you. The average cost is anywhere from $200 to $500 for an inspector. And the only time one is not needed is if you're buying the home as is. Okay? Next is insurance. Now remember, we talked about your mortgage payment, and it's principal, interest, property tax. And you also have to have homeowners or hazard insurance. Sometimes they call it fire insurance, but the general term is homeowners insurance. You must have this the entire time that you have a loan on the property. And again, if your mortgage payment is impounded, it's included in your mortgage payment. However, in escrow, you will choose the company and you will figure out how much that is. It's not just given to you. So you want to shop around. Always suggest that you start with whoever you have your auto insurance with, because a lot of times they give you a bonus or like a discount for having, your auto and your home insurance all together. You want to make sure you get replacement coverage for your property. And depending on the area, you may have to add flood insurance. Okay. Prices for homeowners insurance is anywhere from $5 a month to $250 a month. It can vary. So you want to get quotes from several different people. Also keep in mind when you're getting quotes, the higher your credit score is, the cheaper these quotes will be. So another reason why getting your credit together is important. Once you've gone through all of that, your loan is going along as expected. Oh, the loan. Make sure once you go into escrow that you do not do anything that's going to affect your credit. Just because you're in escrow, do not go out and finance a bunch of furniture or go buy plane tickets to celebrate. Anything that's going to affect your score, you want to wait until after closing, because during escrow, they're going to run your credit again and make sure your score is the same. If there's any change, if you've missed a payment, if you've gotten a new type of loan on your credit, all of that is going to affect your score, and it's going to affect your ability to get the loan that you were pre-approved for. Okay? Once you get to closing, this is the exciting part. Okay? Your real estate agent can be there with you if you'd like. You'll get a stack of papers like this thick, and you'll have to sign your name, sign your name, sign your name. Make sure you understand the escrow company, and your real estate agent can be there to explain what you're signing. You're basically signing over from the sellers to you. The property is now yours. You're agreeing to all of the terms that you have presented in the beginning. They will give you the keys to your home. And if you are due any closing costs, you will bring it there to closing. And a day later, typically, sometimes the same day, title is transferred from the seller to your name, and you'll be able to move in. Pretty simple, right? Now, how has the coronavirus affected this entire process? Well, number one, it's affected our mindset. I talked in the beginning about the benefits of home ownership, and I mentioned to you that when people ask, is now a time to buy? I always say yes, and because prices will tend to go up. However, with what's going on now, I foresee that prices will actually go down. So if you can buy a house, now is the time to prepare, especially while we're on quarantine or stay at home or social distancing and businesses are closed. This is going to affect the economy. A lot of businesses are going to shut down and not be able to reopen. So many people are losing their jobs. So the amount of money in the economy is going to go down. And in order to stimulate that, just how they're sending out stimulus checks, they're going to have to bring prices down. Or what's going to happen is homes are going to be out for sale. People don't have jobs, so they can't buy them. So the seller has no option but to reduce the price. So having your money in order at this time is important. Getting your credit together right now is important, because this is going to be the best time for you to get prepared to buy your home. It's going to be the most affordable option that we can foresee truly in the near future. How that's affecting all of this process is when you come with your budget and your credit. Now, in order to buy a home, you need a minimum of a 620 FICO score. That will qualify. Sometimes 580. If you have a 580, someone can get you a loan. It's going to be a little bit more expensive, higher interest rate, but you can get a loan. 620, however, is the little cushion. 620 will get you first-time homebuyer benefits, and you'll have lots of options. Since the coronavirus or after COVID-19, that 620 minimum has moved up to 640 or 680. A lot of those programs that I listed before are on hold. There's just no money available for them. The amount of money needed as a reserve in your bank account, now lenders are asking that you have money in your bank account sitting already before you buy the home in your account to make your next payment or two. How it's affecting your real estate agent? It, Virtual. We have to communicate like this. We have to do virtual home tours. We can't allow more than 2 people in a home at a time. We can't do an open house. I can do a virtual open house and walk around with my camera and get on social media live, but you can't come in as freely as you can. A lot of agents are requiring you to have a pre-approval and proof of funds before they even schedule an appointment for you to go see a home under this environment. So it's affected the entire 5 steps to home ownership. But it's also a good thing for those of us who are not 100% ready. We're going to have a little bit of time to get it together, and then prices are going to go down, which is going to make it a lot more affordable. So the time is now. Okay, so for a limited time only, I am again accepting 10 more clients to help you step by step on this process. I'm going to send out all these links to you via email where you can click the link and make a one-on-one appointment with me, and we can get started on your 5 easy steps to home ownership. You can schedule if you don't need that much guidance, you don't need the one-on-one, you got it on your own, just led you in the right direction, you know what you have to do. You can buy the book. Buy the book and make sure you're not missing any of the steps. You also follow me on all social media platforms. I'm everywhere at The Real Miss Lacey House. Follow me. I'll be posting more videos, more content, more ways to help us to buy in this particular climate. I hope this was useful for you, and I hope to hear from you soon. Thank you for coming.